Hey, it's Trick Greatmeyer here with Greatmeyer Leonard Financial. It's Monday, March 16th of 2020. Today, I'm going to share with you some ideas and thoughts about the stock market, the bond market, and overall global macroeconomics of what's happening and what to consider as you go forward with your investing. And then in the end, give you some bullet points of things to consider doing and to implement in your portfolios and in your financial life. So let's get going. So the first thing we're going to look at is the volatility index for the S&P 500. What this you'll see here is this measures the basically heart rate or the volatility anxiety rate of the S&P 500. And so what you see here is on the average, if you look at the last weekly moving average of it is 24, ranks as 24%. So very low compared to where we are today, which the last I checked was about 78 ranking or percentage on the volatility index. Anything over 30 is a no-go zone. We do not get in the market. We're not buying. The volatility is through the roof. Things are in chaotic situations. If you go back to the housing crash or the financial crisis and to the tech crash, you see where the VIX will get up to upwards of 50 to 60. Today, we're in that 78 zone. That is parabolic. It's through the roof. So this is not where we are considering buying stocks or investing into the portfolio because of the extreme volatility. So right now the VIX is up there over 30. Anything below 30, we consider reallocating and rebuying into anything. This does not mean we're selling positions. Okay. This does not mean we are getting out of the stock market. What this means is this child is having a temper tantrum, and we have to put them in the corner and allow them to blow up and get the steam off and come down to normal before we can assess and take action on the situation. Right now, this is if you have kids, you know what I'm talking about. They get out of control, they freak out, they go into this temper tantrum, and all you can do is just let them work it out. And that's what we're seeing in the stock market right now. We are seeing panic selling. We're seeing positions that are selling off that traditionally are safe zones. We're seeing those sell off. All right, so the next chart you're going to see here is called the MOVE Index. When the MOVE Index, the world moves. This is a volatility index that measures the anxiety or volatility of the treasury market. Okay, so that's when you see this major move, as we've seen in the last 3 weeks in the MOVE Index, it means that volatility when the US Treasury market is spiking. It's going up. And as you can see here, this thing has just basically gone vertical. Okay. So what that means is there is a major demand for US Treasuries. Why US Treasuries? The United States is the highest credit rating, safest place to go when it comes to global security safety. Number two, you see US dollar is the second place people go. Foreign entities, China, all the other countries out there, they do business in the US dollar. They go and they buy US Treasuries to pick up the yield when yields are high. And when they need cash, they cash those in over what is called the repo market and they get cash. Right now, the spike in treasuries has to do with everything about people wanting cash. They want to put cash in their pocket, specifically US dollars. And number two, they are wanting to put their money in safe places. So that trade has recently been US Treasury market and gold. Now we're starting to see gold sell off a little bit, and that is because people want cash. Now, let's talk about the the event last week when the Federal Reserve came out and said we're going to inject $1.5 trillion into the system. What does that mean to you and me? What that means to you and me is that the engine keeps moving. Think about the Treasury and the 1.5 trillion as oil in your engine. Okay. What was happening prior to them coming out and doing that was that the engine was starting to run out of oil. So the Treasury market was starting to stutter and starting to get freeze up, which causes a massive issue when it comes to the movement of the global economy. When the machine freezes, the global economy stops moving. We saw that back in 2007, during August of 2007, where money market accounts went basically, instead of a dollar for a dollar, they went to like 95 cents to a dollar. So you put $100 in there, it's now worth $95. We do not want that to happen. So the Fed jumping in with 1.5 trillion of liquidity said, hey, the traditional market is not functioning. The people who usually buy those treasuries and provide cash are hoarding their cash because they're scared to death. And so we're going to step in and we're going to create liquidity or oil in the engine and keep this thing running in an orderly manner. It is not, I've heard this so many times, this is not to take care of the billionaires or the billion-dollar corporations out there. This is to keep the economic machine moving in a smooth, orderly manner. So they stepped in with 1.5 trillion, unheard of. I do not remember when that's ever happened. So it's a big deal. It's got the Treasury market moving again. And then this last Sunday, the 15th, they came out and said, we're dumping 700 billion into the system. They're buying securities, mortgage-backed securities, and other items like that. And that is because people want cash. They want cash in their hand because they honestly do not know what's going to happen going forward. And as you've probably seen, companies are sending employees home. They're saying work from home. We are at a pivotal point in our nation, in our world right now in history, that things are shifting. Okay. And it's all because of this virus. All right. So the MOVE index has shown the volatility in the Treasury market is high. Now, let's talk about Treasury yields. All right, so I want you to do this exercise. One, put your hands out to your sides and lift them up like you're standing like in the cross position. Okay? Your left hand is Treasury yields or the yield of a bond, and your right hand, please do this because you'll better understand and remember this. Your right hand is the value of the bond. Okay? When yields go up, so in this case, the Treasury yield was at 4%. Raise your left hand and drop your right hand. Your value of your bond is going to be less. All right. So when yields go down, like they are today, go the opposite direction, your bond yields go down, values of bonds go up. All right. So with that said, the bond yield of the U.S. 10-year Treasury, last I checked, was in the, I believe, 0.8% or so, 0.78%. Okay, so 0.78%. That was the value of, or the yield on the 10-year Treasury, which says, put your arms out, when the yields go down, bond values go up. So we have seen a move in the 10-year Treasury in yields, as you can see in this chart, from a couple weeks ago of 1.5% upwards of 1.85%, all the way down at one point last week of I believe right around 0.3%. So 0.30%, which means everybody was running into U.S. Treasuries. Why? Because of safety. Okay, everybody's running to U.S. Treasuries saying we got to go to the safest place, and they're investing and buying 10-year, 30-year Treasuries, pretty much anything U.S. Treasury related. You've seen the yields drop there. All right, so if you've seen that drop and you've been in 10-year Treasuries or 30-year Treasuries or Treasuries in general, you have made money in this market. As long as the 10-year or 30-year treasury are below their averages, it's because there's fear in the market. Relate that back to the MOVE index. Like I showed you earlier in that chart, you've seen a spike in anxiety in the US Treasury market, and the US Treasury yield has dropped, which then means the value of those treasuries have gone up. Okay. All right. So there is a flight to safety right now in the marketplace. You've seen this building over the last, say, 4 or 5 weeks. And within the institutional world, you've been seeing this building for quite a while now. So, what do you do today? Step one, you need to breathe. Take a deep breath and relax. Having high anxiety, freaking out about this is not going to solve problems. So take a deep breath. Number two, how long till you need the money? Okay, so are you 5 years from retirement, or are you 10, 20, 30 years from retirement? Okay, if you are over 5 years till retirement, then you need to check your asset allocation and make sure you're comfortable with how it's allocated. And number two, you need to be patient. Okay, time is on your side. This market will recover at some point. As extreme as it is, I do not know how long it will take to recover, but it will recover. We have seen this going back to the 1700s. It has happened before, extreme moves in the market like this, but things eventually work themselves out. So be patient. If you are within 5 years of your retirement, we should talk. Here's why you need to talk. Because you need to check your asset allocation, because chances are this market will go down further. Okay, if you're within 5 years within retirement, we need to check that asset allocation to make sure it's within the means that you can endure this downturn. If it is not, we need to consider making changes. That doesn't mean we run to the hills and cash out. We reallocate your portfolio to be more conservative, to lessen the downturn. So if you're within 5 years of retirement, contact me, and I'll leave my contact information at the end of this video. If you're 5 years greater, so like 10, 20, 30 years out, look at your asset allocation, be patient, and understand the more you put in during these downturns, the more you're purchasing, which means through that dollar cost averaging process, you're buying stocks at lower prices, sometimes a little higher, but a little lower. And by doing that over time, you end up winning. All right, so if you're worried, you're concerned, you're fretting about this, contact us. Our team is here to help you get through this, help you solve these problems or answer these questions that you may have. So please reach out to us you can call us at 205-970-9088. What we'll do is schedule a time to do like a 20-minute call to walk you through what your options are, answer your questions, that kind of thing. Number two, if you want to reach out to me via email, you can email me at tag@grinkmeyerleonard.com. That's tag. Yes, those are my initials, believe it or not. tag@grinkmeyerleonard.com. Whatever you do, if you have questions and concerns, please use us as a resource to help you answer those questions and concerns. At the end of the day, we are here to help you achieve your dreams and goals. We're here to answer your questions. And if we don't know the answer, we have a whole incredible team who knows that answer. So please stay calm, be patient, and understand where you are today. Use us as a resource. I look forward to talking to you. I hope this has been helpful. In the meantime, be safe, stay healthy, and enjoy and live life loud.